Good afternoon, everyone, and thank you for taking time to join us today. Welcome to Alpha Credit Advisors AAA Investor Connect. Every market cycle has a number that investors become obsessed with. During bull markets, it's the index level. During correction, it's the percentage drawdown. Today, that number is Nifty's price to earning ratio. At around 22 times earnings, it's quoted everywhere. It's used to argue whether the market is expensive or cheap, whether investors should deploy fresh capital or wait for correction. The appeal is obvious. One number, one market, one answer. Unfortunately, market rarely works that way. The real problem with the Nifty's P ratio isn't that it's wrong. It's that it hides far more than it reveals. Like a mirage, the closer you look, the more the picture begins to change. To uncover what the index valuation is really telling us, and more importantly, what it isn't, I'd now like to invite Mr. Rajesh Kothari, founder and managing director of Alpha Credit Advisors, to take us through this fascinating story. Welcome, Rajesh.
Thank you, Sandeep.
Rajesh, just to take us through the topic as briefly about the AAA schemes as well. Thank you. Over to you, Rajesh.
Thank you. Good afternoon and good evening to all of you. Thank you very much for attending this webinar. And I think last webinar was on 10th April. And the topic of that webinar was act or wait. And from there, look at the markets and look at the news flow. And I'm sure many of you would have attended that event, which was on 10th April. And on that day, we presented very few important slides, which clearly depicted that this war is not for the first time equity markets have seen. We have shown actually in that presentation that this is the 10th war in last 42 years. And every time, whenever such war happens, of course, market first goes down. But doesn't it remain same that low levels for a very long time? The average drawdown generally was 10%. And average recovery time is less than 80 to 90 days. And this time is no different. The war news broke out on 28th of February. And by 31st March, market made a bottom. Is exactly went down 10%. And we recommended on that day to all our investors, participants, partners, that this is a time to add to equity as an asset class. There are so many concerns, but today I'm sure most of that concerns are now addressed. The war may still continue to go on, just like how the Russia-Ukraine war is right now going on. It is now almost 4 years. But what is most important is not to focus on the headlines of war, but rather to focus what is something most important for Indian economy, and that is a crude oil price. The ability to get crude at that particular price. And I think that the worst is over. So with that, let me now quickly go into the market outlook, and of course, we'll further go into decoding the valuations. Friends, every quarter, particularly when markets are in a correction mode, whenever we meet large family offices or even the individual investors, we get different kind of concerns. The concerns keep changing. At some point of time, like 4 months back, the concern was US-Iran war. Now, of course, with the settlement and the, I would say, kind of MOU between the two countries, the crude oil is now back to where it was pre-war, which is a good news. The second big concern was FI outflows. And let me just highlight you one important slide which I presented even last time. that what is our view on that FI outflows. Please give me one moment. If you look at this slide, there is a heavy FI outflows in both 2025 and 2026. But just like any normal individual investor, FIs also look at two important things. One is growth, and second is a valuation, what we have to pay to buy that growth. And if you look at this slide very carefully, the MSCI India price to earning multiple, when you compare that with MSCI emerging market price to earning multiple, we are almost 12 years back to that levels. We are almost back to FI14 levels. The premium discount is right now at almost at 1.35, is one of the lowest what we have seen in last 14 years. And hence, in month of April, we said that probably as and when the news flow related to US-Iran war comes back to normalcy, we also believe that FI outflows first will reduce. It is a chain of events. The MOU between the two countries, number one. Number two, results into the lower crude oil price. Number three, results into the lower inflation pressure. Number four, results into appreciation of currency rather than depreciation of currency. Number five, lesser pressure on India current account deficit. And number six, result of all these things, better improvement in earnings growth. And when this entire cycle reverses, one after other event happens, the pressure on the price to earning multiple also reduces as the earnings growth takes the front seat. And as and when the earnings growth take the front seat, and that's what any investor look for, be it global or local, NFI therefore will come back to Indian markets. And hence I strongly believe that from now, here onwards, as the crude oil is already pre-war levels, FI outflows will reduce gradually, and then slowly they will also start making investments in India. This was one important concern. Many investors in my one-on-one meetings, whenever I used to meet them, this was a very important highlight, that why FIs are selling and when we believe they will come back. Short answer to that question, we believe that FI will come back very soon because most of the macro pressures are behind us. And then as we come out of that pressure, the most important concern which I keep hearing, and I also keep reading a lot of articles, that Indian markets are expensive at 22 times price to earning multiple. Many investors believe that what India offers as a growth, and when you compare to the PE multiple, the margin of safety is not in our favor. And I thought today, let me take this opportunity to decode this valuation, how actually one should look at valuation, what are the right matrices when you evaluate any sector and any company, before we go further into AAA strategies. Friends, price to earning multiple is just not a measure of cheapness. Price to earning multiple actually denotes a lot of things. Let me just show you one important slide, that how the current Nifty PE, when you look at that 22 PE, the combined blended PE, what actually it reflects. So as I said, PE is just not a measure of cheapness. It is rather reflects the quality of business. And generally speaking, there are three quality of business. One is high quality, one is low quality, and one is something in between called medium quality. How do we define quality? Quality is defined by the nature of business. Whether you are a price taker or whether you have a pricing power. For example, consumer businesses with a high return on capital employed are high quality businesses. Pharma business is a high quality business. When you compare this with aluminum, steel, metals, oil, gas, refineries, they are price takers. They have to accept whatever the market decides. At times, the cash flows are in a very poor condition. At times, the ROEs can be even zero. At times, this business can be loss-making businesses. And therefore, it is labeled as a low quality. Of course, each company within that might have a very superior business outlook and might be doing business differently. That's a separate issue. But generally speaking, consumer, pharmaceuticals, healthcare, hospitals, retail, telecom, these are defined as a structurally high cash flow generation business, more structural business, more pricing power business. Compared to that, oil and gas, metals, and many such other businesses are kind of a low quality businesses. They don't have pricing power. And there are some businesses which are in between the two, and therefore they are called as a medium quality business. For example, automobiles, auto ancillaries, ports, this kind of businesses they are medium quality businesses. They are not as strong as consumer business with a 75% ROE structurally. At the same time, they are not as bad as commodities with at times only 5% ROE. They are in between, like automobiles, as I said. And of course, Nifty has a one very large sector which is called banking and finance, which itself is also 33% of Nifty. So when we look at Nifty, we need to look at these four buckets. High quality, 16% of Nifty, trades at roughly 43 times price to earning multiple. Medium quality, which is roughly 20% of Nifty, trades at roughly 23 times price to earning multiple. Low quality, 30% of Nifty, trades at roughly 18 times price to earning multiple. And banking and finance, 33% of Nifty, trades at roughly 19 times price to earning multiple. Of course, banking and finance more we should look at on price to book basis rather than price to earning basis. But just to give you a color, because when everybody says Nifty is trading at 22p, they give a blended number of 22p. They do not say Nifty excluding banking. So I thought to put even here the banking and finance price to earning multiple. And now the interesting thing starts. So when you believe that 22 times is cheap or expensive or 18 times is cheap or expensive is actually wrong way to look at Nifty. What you need to look at it is whether the good quality businesses, whether the high quality businesses, are you getting at a lower P? Whether the medium quality businesses, are you getting at a lower P compared to what they used to enjoy? Everything is relative. And of course, the low quality businesses, in case if one wants to buy that, then at what valuation you are getting it compared to their historic valuations. So blended P, I repeat, has no meaning, and hence never judge the market by the index P, because index P is average of extremes. On one hand, you have a steel company trading at below 10 times price to earning multiple. You might have oil marketing companies which might be trading at 7 times, 8 times price to earning multiple. And on the other hand, you might have a super consumer businesses trading at 85 price to earning multiple, but at 22p you feel index is cheap or index is expensive. Both are wrong. What therefore we believe when we look at valuation framework, we believe into the four buckets. There are businesses which are at low P but high growth. There are businesses which are high P and high growth. There are businesses which are high P but low growth. And there are businesses which are low P with low growth. Clearly, if you get low P with high growth, it is a super sweet spot because you are buying the high growth. At the same time, you are buying at a very high margin of safety. And when you compare this with a high P, high growth, again, is a growth at premium you are buying. But since the growth is very high, and if the growth maintains that momentum, that sector and that company may continue to command high PE. Third is low PE, high PE and low growth. That's dangerous because both are wrong. Your PE is also wrong and growth is also coming down. It means clearly it's going to be a very, very dangerous zone, and stocks might see 20, 30, 40% price correction. And fourth, of course, is the low PE, low growth, classic value trap. And there are many, what I would say, investors, they say that, we are very valuation conscious, prefer to buy any business with a below 10 PE. Sometimes it can be a real trap because they are cheap for a reason. The business might have the zero growth potential. There might be poor capital allocation. There might be poor corporate governance. There might be highly regulated business, and one regulator policy can change your underlying business fundamentals significantly, and this can remain value trap for a very long time. So what is our philosophy? That I always say that for us it is a GARP, growth at reasonable valuations. Quality first, never compromise on what we buy. There has to be growth to that quality. Just buying high quality stock doesn't necessarily mean it will create wealth. All great companies are not necessarily great investments. Of course, all great investments, they have to be great companies. So buy quality, never compromise on what we buy. Buy only if there is a growth, and buy at a reasonable price to earning multiple. We need to keep valuation discipline. We need to avoid the danger zone of overvaluation. And at the same time, we need to also avoid the value traps. And that's basically what is our philosophy. Let me give a few examples of what I mean by this. Let me give one example, the India's leading pharmaceutical company, Sun Pharma. And I've plotted in front of you the last 5 years. And I'm also plotting in front of you the trailing price to earning multiple, how much the stock is delivered in terms of stock price appreciation, and also in terms of the earnings growth. Look at this very closely. In FY22, any investor who would have bought at a trailing P of 62 times, P looked high. Optically, P looked high. But company delivered 21% earnings growth and stock delivered 53% stock price returns. So even if you bought at a high P, since the earnings growth was also very high, stock continued to deliver. Remember, FY21 was, industry was still coming out of COVID. But in FY23, the price to earning multiple was 64 times. But at 64 times, earnings growth was only 10%. And company gave only 8%. But the next year, when the valuation dropped and the company delivered 16% earnings growth, stock delivered 65% returns. Because the valuations were in your favor, because stock price corrected, and so valuation came attractive, and at the same time company delivered very strong earnings growth. So earnings growth plus valuation re-rating both resulted into 65% stock price returns. And in the following years, even if you would have bought at 37 times, 38 times, the returns were suboptimal, only 2, 3, 4, 5, 6% returns, because earnings growth also became very moderate, only 10% earnings growth. So the conclusion is, if you therefore look at on PEG metrics, and that's why we keep saying PEG is the right, better tool to look at, is that P divided by EPS growth, then it is a far better tool rather than absolutely using just pure price to earning multiple. Let me give you another example of Hero Motor. Somebody who bought it at 19 times price to earning multiple, but earnings growth was minus 15%. Stock delivered minus 21%. So if there is a degrowth, market is also gave negative returns. The next year earnings growth was 11%. Stock gave just 2% because earnings was still moderate. It is not very high growth. But in the following year, earnings gave you 44% return. And since earnings bounced back to 44% growth, stock also gave a super returns of 101%. So again, what I'm saying, like look at here FY26, again earnings growth rebounded to 22% and stock delivered 42%. Of course, there is no, what I would say, 101 formula. There is no exact science that how much growth and how much PE, how much PEG. Unfortunately, life is not so straight. But I'm just trying to give you some trends, the direction in which one should look at it. One should look at the quality of business. Is it a high quality, medium quality, low quality? Number one. Number two, one should look at what is the business cycle. Are you entering into a growth phase? Yes or no? And number three, very important, at what valuation you are buying this inflection point. If you are buying that at very high valuation, then again returns might be suboptimal. But important thing is to predict the growth. If you go right on predicting growth, like Hero, look at this, growth 22%, stock gave 42%. So if you go right on growth, and if that growth continues, then chances that you make reasonably good returns are in your favor. Let's look at Infosys. 30 times price to earning multiple, earnings growth was 14%, stock gave 40%. Because remember in FY22, everything is relative. Nifty earnings growth was not even 14% because market is coming out of COVID. And in the following years, look at this. The earnings growth became only 2%, stock gave only 5%. And of course here, the earnings growth actually, this earnings growth is more because tax rate cut, but otherwise the PBT growth is only 8-9% and stock went down 20%. So despite same price to earning multiples, the outcomes are different because of the earnings growth and of course future outlook of the earnings growth. Look at case, for example, transmission company called Hitachi. If you look at here, 91 times price to earning multiple, earnings growth was negative, stock also gave negative returns. And then company delivered 74% growth, stock price went up almost 100% plus. So even if one bought at 150 PE, because it was a 2 times PEG, 150 divided by 74, investors were rewarded. In the following year, earnings growth became 134% and stock went up 91%. PE remained high because think of it, 180 divided by 134, you're still buying below 2 times PEG and stock kept delivering 91%. In the following year, earnings growth was 171 and stock gave 100%. Think of it, PEG actually became less than 1. 146 divided by 171. So important is to, number one, see the quality of the growth, quality of business, and second, what is the growth? If anybody would have predicted a company to grow for 3 years, 100%, 100%, 100%, definitely stock will reward you maybe more than 100%, maybe a little bit less than 100%, but definitely is going to be the handsome returns. So I just thought to, share with you the how not to get, what I would say, influence by just one PE ratio, because we see a lot of articles, a lot of TV debates, whether India is expensive or not. Nifty standalone PE on its isolation basis, it doesn't reveal much. You need to break down Nifty into the various sectors depending upon the quality of businesses. And that quality of the business basically will decide what kind of structural PE a company deserves. And there are years when the business cycles are going to massively accelerate your growth. In such years, a PE may remain high, on optically PE is high, but think through it, actually it is a very low PE if you can predict the future growth rate. Of course, if the growth comes down massively, then the thesis goes wrong, because in that case the PEG becomes very high. So the very important is how to understand the business cycles of each of that company. Like this is a classic case of FMCG company, and look at this company delivered absolutely very poor earnings growth, 1%, 5%, and therefore stock is also languishing. Stock is not going up anywhere, and the PE remains about 50 times or 55 times. So I just thought to explain you in terms of how do we see the the valuations, and how one should actually interpret those valuations. Dipping down into our AAA strategies, and let me start with the mid and small cap offerings, which is called AAA Budding Beast, and then we also move, of course, to our multi-cap flagship plan, AAA IOP. But before I talk about AAA Budding Beast, let me re-highlight that India is the only country in the world where top 100 by market cap is called large cap. It means out of 5,000 listed companies, 2% of India is large cap. It means 98% of India are tagged as a mid and small cap. And we said it can't be like this. We said let's look at the profit size of the companies. In India, there are only 1,000 companies, which makes 100 crores plus reported net profit after tax. Only 1,000 companies. So these 1,000 companies are actually big companies. But of these 1,000, only 100 are tagged as a large cap and 900 are tagged as a mid and small cap. AAA mid and small cap strategies, both our AAA Budding Beast PMS as well as AAA GEMS, and also the mid and small cap component of our multi-cap products, AAA India Opportunity and AAA India Equity Fund. This is our focus. The next 900 is our focus. And therefore, AAA mid and small cap strategies are probably one of its kind because it offers the strength of large with the speed of mid and small. It offers the resilience of large with the growth potential of mid and small. Because the companies what we buy, they are market leaders with the very large revenue size as well as profit size. They are the oligopolies, they are the duopolies. Many of them are the market leaders, real market leaders with a super governance, super balance sheet, and super management. That's basically about our mid and small cap strategy. The fourth quarter numbers have been very solid for AAA portfolio, and for FY26, AAA Budding Beast delivered 25% earnings growth. These are the portfolio characteristics. I always believe in quantifying the quality. AAA Budding Beast today has an average weighted market cap of 49,000 crores. If you look at the companies, they all are market leaders. Just to reiterate, our stock selection approach is a 3M approach: market size, market share, margin of safety. We have identified 40-50 subsectors in India where there are category leaders. There are only 5, 6, 7, 8 players market, which makes them oligopolies and monopolies. We buy such companies which have a tremendous pricing power. They are category leaders in their respective industry. We buy when we believe that they have a very prudent balance sheet, lesser leverage, preferably net cash companies. And such companies we buy provided they offer growth, and we buy at a reasonable valuations. So AAA Budding Beast PMS characteristics, all of our portfolio companies, as you can see here, most of them are 100 crores plus reported net profit after tax. Most of the portfolio companies, they are cash rich in terms of the balance sheet. They enjoy good pricing power reflected in 16% ROE, and we buy only if there is a earnings growth. Our portfolio has a very strong 25% earnings growth. In terms of the PEG, this portfolio is a below 2 times PEG, but with a much solid earnings growth and ROE compared to BSE 500 index. How this portfolio has performed during bad times of the market, because I think that's something important. Russia-Ukraine war, I'm sure many of you are investors. They've invested with us, and they've seen that during Russia-Ukraine war, when markets were down heavily, our fall was much lesser. Our fall was lesser with a clear objective of protect capital and create wealth. And of course, after that, market recovered. Market went up almost 48% small cap. BSE 500 went up 32%, but we went up 51%, outperforming the market rally. And last 18 months, again, were a very challenging time for the market. Small cap is down 10%, BSE 500 is down 6%. And in such challenging time, our fall, we are just almost flat. Falling less during bad time, rising more during up time, delivering alpha across the cycles consistently. And that is something USP about alpha accurate advisors. In terms of performance, how this portfolio is delivered, in last 1 year, markets were flat. We have delivered 11% returns. In last 2 years, markets delivered 4.1. We delivered good 14.5% compounded returns. In last 3 years and 5 years, market delivered roughly 12 to 13%. We delivered very solid 23% compounded returns in last 3 years and 5 years, and 25% compounded returns since inception of 5.5 years. We have delivered alpha across 1 year, 2 years, 3 years, 5 years, and that too substantial alpha compared to benchmark indices. Interestingly, beta of the portfolio is less than BSE 500. BSE 500 is a 60% large cap, and still, despite very low large cap, our beta is less with a much stronger alpha. When you look at our performance on a year-wise basis, 6 out of 6 financial years, we have delivered very solid alpha compared to BSE 500 indices. In absolute terms, 1 crore has become 1.92 crores in 3 years, and almost 3 times 2.91 crores in 5.5 years. In terms of the rolling returns, portfolios delivered very solid 24% compounded rolling returns compared to benchmark returns of 14.3%. So this is about AAA Budding Beast. Very briefly, AAA Gems Fund, what we launched about 4 or 5 months back, is a 30 stocks portfolio in mid and small cap strategy. Earnings growth has been very solid for this portfolio, 34% earnings growth, and of course, very solid portfolio characteristics. Average weighted market cap 55,000 crores. Most of the companies with 100 crores plus profit, with a cash-rich balance sheet, high ROE, and high earnings growth. This portfolio, since its launch on 23rd January 2026, have delivered very good performance compared to benchmark, which is up just 0%, like flattish. We have delivered 12% returns. Even in last 3 months, we have delivered 8.6% compared to benchmark minus 2%. Solid alpha since its inception of last 4.5 months. Coming to our multi-cap flagship plan, AAA India Opportunity PMS. Again, this portfolio has delivered very solid earnings growth. For the 4th quarter, our portfolio delivered 26% revenue growth and 20% profit growth. In terms of portfolio characteristics, the average weighted market cap is roughly 350,000 crores. Most of the portfolio companies are 500 crores plus reported net profit after tax. They are really very large. Most of them are debt-free or debt equity less than 1, with a strong ROE and of course, very strong 25% earnings growth. And that earnings growth, current valuation, when you look at it, is roughly about 1.3 times in terms of PEG. Again, much better compared to BSE 500, but with a stronger growth and better ROE. In terms of how AAA Multicap has performed in last 6.5 years, during bad times and during volatile times, 16 out of 19 periods, it has outperformed the benchmark indices with a lesser drawdown. And that's always important and remains our first priority. In terms of the CAGR returns, in 1 year it is -1, 5 years 5.4, 3 years and 5 years 14% and 13%, and since inception 17.3%. I always believe that year-wise returns are more important, and therefore I also wanted to plot here FY26 as well as current year FYTD 27, FY26 -5 compared to benchmark -3. In terms of rolling returns, it is a 20% rolling returns compared to BSE 500 rolling returns of roughly 14.5%. AAA India Equity Fund similarly is 1.3 PEG, and again with a solid growth of 20-25% in terms of the earnings growth for the fourth quarter. It has been now 3.5 years since its launch, and it has delivered 14.4% since inception in 2023. So this is about the both the strategies, multi-cap as well as mid and small cap strategies. Just to conclude, in terms of the market outlook, we believe that the worst of the news flow is behind us. Earnings growth in first quarter is definitely going to be a little bit soft because the corporate India would have got impacted because of the higher crude oil and also the supply chain issues. But as we move forward in 2Q and then 3Q and 4Q, earnings growth is going to improve. That's number one. Number two, RBI has taken various steps to ensure that currency depreciation doesn't happen at this pace, and FCNR and many other steps what government and regulator has taken, we believe will lead to currency stabilization, and I won't be surprised if even INR appreciate to certain extent in short to medium term. In terms of crude oil prices, we believe that the worst of that crude oil volatility is also behind us. While volatility may remain, but the high crude oil prices days, I think that's over, and probably crude oil will settle below $75, which was at pre-war levels. Point number 4, the fear of hiking interest rate is also probably behind us, because as inflation cools down, there is no need to increase the interest rates. And last but not least, in terms of the FI flows, as I mentioned in detail, we believe that even FI outflows first will reduce and then FI inflows will start. Having said on the macros, let me tell you, there are so many pockets of opportunities across various sectors. And as a fund manager, our job is to identify such pockets of opportunities and make sure we take the right prudent risk weightage on such companies. There are opportunities in auto ancillaries. There are opportunities in banking and finance, in housing finance sector in particular. There are opportunities in consumer discretionary, for example, building materials. There are opportunities into entire power value chain, particularly transmission related sector. There are opportunity in EMS because government is continuing to support through PLI schemes. There are opportunities in hospitals. There are opportunities in CDMO space. So in every sector, there are pockets of opportunities. Across our portfolios, we are bullish on these segments which I just now mentioned. Auto ancillaries, select banking and finance, select consumer discretionary, hospitals, CDMO, EMS, and capital goods, and of course, the platform companies. Government continued support to make in India, I think, will result into continued buoyancy into the capex. While the general capex may see some slowdown from the central side, considering the government finances are under some pressure, we believe data center related capex will continue to see big momentum. We believe that defense related capex, maybe with a 1 or 2 quarter postponement, may again will revive. We believe the nuclear related capex will continue to do well. We believe that the entire value chain of the transmission related sector, that will continue to do well. India is a huge spender globally for buying the planes. So aerospace is going to be very interesting sector, and there are companies, particularly in auto ancillaries, which are diversifying away from traditional auto business to aerospace and defense. So there are good opportunities in auto ancillaries. Premiumization of the vehicles, rising content per vehicles, more sensors, more regulations, all these things will lead to good days ahead for the auto and sector in general. For banking and finance sector in particular, last year was challenging because interest rates, there is a difference between timeline difference in transmission of interest rates, and that resulted into pressure on net interest margins for most of the banks. However, if you look at in the current year, the credit growth has already improved from 9% to 13.5%, 14%. This is a very important data point because the credit growth reflects the macroeconomic outlook. So improvement in credit growth, number one, and also the pressure on net interest margin is now no more relevant. That's number two. And with the right asset quality, number three, we believe that the banking and finance sector will continue to do reasonably well for next 12 to 18 months. In consumer side, we are more bullish on discretionary and less bullish or less positive rather on FMCG. And within discretionary, there are multiple pockets like building material is one segment on which we are positive. Retail is another segment on which we are positive. There are few more special discretionary items within consumer and on which we are very positive. On capital goods, the transmission capex remains our major theme, and that includes data center related play, that includes the robotics related play, that includes the AI related play within the entire capex stories. Hospital as a sector, we believe that there is a good amount of capacity expansion by top players in last 3-4 years, and it is a time that over next 18 to 24 months, a lot of these capacities are now going to come on stream. In the initial years, this hospital makes losses. Whenever new hospital gets added, first year is always a loss making. But from this year onwards, few companies, these losses are going to reduce because they achieve the break even. So hospitals will see good revenue growth, good profit growth, and of course, a reasonable valuation as I speak with you today. So this is basically from the sector's perspective, the sectors on which we are positive, and that's what we are holding across the portfolios. So that's it from my side, and probably we can open it for question and answers, and please feel free if you have any queries. Thank you so much for hearing us very patiently. Thank you.